Hello everyone, my name is Gifmo Maguju and welcome to yet another tutorial on ratio analysis. So today we are going to look at Shoprite. So Shoprite Holdings is a company that is listed on the Johannesburg Stock Exchange. So we shall be conducting the 5-year ratio analysis, right? So without wasting time, let's dive right into it. So this is the ratio analysis tab. It's blank for now, and we have got the balance sheet here, and we have got the income statement here. So this is the consolidated income statement, and this is the consolidated balance sheet, right? So so I got these figures from their investor relations website, and that's where I downloaded the annual reports from 2018 to 2023. So these are historical figures, right? And I think I've got so I've got the Shoprite Holdings here. This is their annual financial statements, 2023 annual financial statements. So you can see here, let me just zoom that, so you can see the consolidated statement of comprehensive income. This is 2022 to 2023. So we shall be referencing to this annual financial statement report. So let's go back to our Excel. So here, first of all, we want to start by computing profitability ratios. So the reason for a profit-oriented business is to make profit. So that's why we have to assess the profitability of the business. So here we want to see, is the business making profit? What are the margins like? Okay. So we will compute the revenue, the 6-year revenue CAG, and we also compute the revenue growth rate. This is the year on year. And we also have to compute the gross profit margin, the EBITDA margin, EBIT margin, and net profit margin. And we also compute liquidity ratios to assess whether Shoprite is in a position to meet its short-term obligations. And we also compute the efficiency ratios and also the financial leverage ratios, right? So these are just basic ratios that you need to know. So let's start by computing the revenue 6-year COG. So what we are going to do is we press the equal sign to initiate the formula, and then we open a bracket, and then on my keyboard I'm going to press I'm going to hold down Control and press page down to get to the income statement. So here I'll select the revenue figure, that's sale of merchandise revenue figure for 2023, and I'll divide it by the revenue figure for 2018, and then I'll close the bracket, and to the power 1/6, right, minus 1. Okay, so here let me turn that into a percentage. So Alt HP. So now we have computed the 6-year COG. So we're saying that Shoprite Holdings revenue is growing by a COG of 7% annually, right? And now we want to compute the year-on-year revenue, right? So here let me just highlight that. So let me highlight it using this so that it stands out. So now we have to compute the year-on-year revenue growth rate. So here I'm gonna press the equal sign, and then I'll go to the income statement. I'll select revenue for 2019. I'll divide it by revenue for 2018 minus 1. And then I'll press enter on my keyboard. and then I'll copy that to the right. So I'm going to turn that into a percentage, old HP. Okay, so we are seeing that revenue in 2019 for Shoprite grew by 4%, and in 2020 grew by 3%, 2021 8%, in 2022 9%, and in 2023 revenue grew by 17%. Now let's compute the gross profit margin. So gross profit, this is the portion of revenue that is left after we have subtracted the cost of sales. So let's just do that. So here we just go to the income statement, we select the gross profit here, we divide by the revenue, and then we turn that into a percentage, and then we copy that to the right. So we are seeing that revenue, our gross profit, this is 24 in 2018 the gross profit margin was 24%, and so we are just seeing that the trend revenue is the gross profit margin is oscillating between 23 to 24% thereabout. So even if we compute the average, we can get to 24%. So right, so here we are saying that management has been able to manage to just keep the gross profit margin constant there. Okay, so they've been able, let's say, to manage or contain cost of sales, except for here where we are seeing in 2019 I think cost of sales were high, right? And so we have got a gross profit margin of 23%. Let's compute the EBITDA margin. So EBITDA, we are saying this is the earnings before interest, tax, depreciation, and amortization. So here this margin tries to track or assess the income that the company is being able to generate before factoring in non-cash expense, which is in this case depreciation and amortization. So in other words, this is just income from operations. We're just trying to see how management, the efficiency of management to turn, to generate a profit from operations. So here we've got the EBITDA margin. So we just go to the income statement, and then we select the EBITDA margin, we divide it by revenue, and then we just copy that to the right. So we turn that into a percentage, and let's do this for EBIT. Now EBIT, we have removed depreciation. Now let's go back and we select EBIT, we divide it by revenue. Okay, so we just copy that to the right. And so we are saying that the EBIT margins are around, they're oscillating between 5% to 8%. So not that bad, since Shoprite is a retail, is is a supermarket, is in the retail sector. So these margins are not that bad. And now we have to compute the net profit margin. So net profit margin, net profit is the residual income. This is revenue left after we have paid our suppliers, paid our employees, our contractors, after we've paid the government, after we've paid our lenders, the government, so that's it. So we have to see that. So we are going to use the profit for the year from continuing operations. So here let's just go to the income statement. Let's look for profit from continuing operations. So we divide that by revenue, and then we turn that into a percentage, and then we also, right, so here we can see that our net profit margin has been consistent at 3%, except for 2018 where it has been around 4%. And now let's compute the return on equity. So the return on equity ratio, it's a ratio that if you're an investor, you have to closely monitor the return on equity, because it shows how much the investor is getting for the capital that they've invested into the business. So here we just we are going to use the average figures. So the formula for that is net income divided by average equity, right? So here we just choose the profit from continuing operations for 2019. So we divide by average equity. So we go to the balance sheet. That's where we find equity there, total shareholders equity. So we're going to take the book value here of equity, and then we turn that into a percentage, and then we copy that right through. So we are seeing that the return on equity ratios has been improving consistently, trending upward, which is a great sign, a positive sign. And here let's compute the return on assets. So we are going to use average values as well. So here we go to the income statement, we take this, we divide, we say average, we take the book value of assets, so book value of total assets, so that's it, and then we press enter, and then we turn that into a percentage, we copy that right through. So yeah, we're seeing that it has been a little bit volatile, but it's keeping constant at 7%, which is not bad as well. Right, so now we are done with profitability ratios. Now let's move to the liquidity ratios. So we are only going to look at a few ratios, we're just looking at two. So the current asset ratio and the quick ratio. So the current asset ratio compares current assets to current liabilities. So in a way, we are trying to gauge whether Shoprite is got the financial standing to cover its current liabilities using the current assets, right? So here what we are going to do is we are going to initiate the formula. We go to the balance sheet. So these are balance sheet ratios, and then here we are going to just select here. So this divided by current liabilities, which are these, and then we copy that right through. So here we can just do like this. So we are saying in 2018 Shoprite had $1 of current assets, which it could use to cover $1 of current liabilities. But here we are saying it's got 1.2, we could just say $1.2 to, which could cover $1 of current liabilities. So we're just saying a current asset ratio greater than 1. I think it's reasonable. Not when looking at the Shoprite Holdings current asset ratio, it's not that bad. Okay, and now let's look at the quick ratio or asset test ratio. So this ratio now, it compares current assets minus inventory to current liabilities. So what we're trying to say is we are taking most of our liquid assets, that is by definition current assets are assets that can quickly be turned into cash, right? And within the current asset, right, we have got some ratios which are highly liquid than others. We have got some assets there which are highly liquid than others. For example, cash is highly liquid because it could be cash on hand or cash at the bank, and can be quickly utilized to pay for interest payments or our suppliers, something like that, or meet some immediate cash needs. So inventory now, it could take long to get sold, so it's not that highly liquid. And we've got trade receivables. Now it depends on when we are trying to rank in order of liquidity. We are saying trade receivables are highly liquid than inventory. So here we are just removing inventory from the total current assets figure so that we can compute the quick ratio. So let's just do that here. So here we are going to the balance sheet again. So from the balance sheet, we are going to select this figure, total current assets, right? And then we subtract inventory, right? And then we divide by current liabilities. So the total here, right? So we are seeing that it's actually bad without inventory. Shoprite is in a bad shape. It can't cover all the current liabilities, right? All the current obligations that are likely to fall due within a year. So another way of computing this is we can come here again under current assets, and then we neglect that, and then we just highlight here, and then we say divide by this. So we can still compute that, it will still work. Okay, so let's just ignore that. So let's just link through our current assets from the balance sheet. So we're just going to link this figure here, and we're also going to link the current liabilities figure. So let's just link that through current liabilities. We link that. Perfect. So here we just compute the operating working capital, which is just essentially current assets minus current liabilities. So we are seeing that the current assets for Shoprite are enough to cover all the current liabilities, right? So let's just put a top border there. So it looks great. Now we are done with liquidity ratios, and now let's go on to computing efficiency ratios. So here we're just trying to, by definition, there's a definition that I love. That's in this book. So let me just quickly go right up here. Okay, so these are operating efficiency ratios. So here we're saying efficiency ratios examine how the management uses its assets and capital measured by dollars of sales generated by various asset or capital categories. Okay, so this is a great definition that I love about efficiency ratio. We're trying to see how management is using its assets, right, or its asset base and the invested capital to generate sales. Okay, so that's basically it, that what we are trying to do there. Okay, so let's go back here. So we want to compute the inventory turnover ratio. So to compute the inventory, we're just trying to see how many times is Shoprite Holdings turning its inventory or replenishing its inventory. So to do that, we say cost of sales divided by average inventory. Okay, so let's just do that. So here we just put a negative there because, so I think to use average inventory we start at 2019. Okay, so let's just do that. In 2019, average inventory, negative there. So let's select that and then divide it by average inventory. Okay, so average inventory, we can get it here. Okay, average inventory, then that's fine. We copy that to the right. Okay, so on average we are saying it takes Shoprite Holdings to replenish. It replenishes its inventory about at a constant of seven times. Okay, 7 times per year, right? Because these are yearly figures. Okay, so let's see how many times does Shoprite Holdings collect money from its customers. So here we're gonna use the 2019 revenue. So here we're gonna use that and then average. So we take average trade receivables in under current assets here. So we just copy that to the right. So you're saying on average, we are saying Shoprite in a year, they take, in 2019, they took about 33 times. They collected, money from their customers 33 times. In 2023, 40 times. So I think they're now speeding up collection of money from their customers, which is a good sign, because and also for inventory, I see there's an improvement there. Right, they are trying to increase the number of times they are replenished, which means they are a bit like, selling more. Right? They're pushing volumes faster, which is a great sign, by the way. And let's see how many times they pay their suppliers. Okay, so we use cost of sales again for 2019. Okay, so we divide that by average. We divide by average trade and other payables here. Okay, so we just copy that to the right. Perfect. All right, so we are seeing that these guys, they are paying their suppliers, in 2023 about 7 times in a year. Okay, against a 40 times collection. Okay, I think this is great, right? I think it's reasonable. It's a good sign. Now let's compute the inventory processing period days. We want to see how many days. Now we got the times, right? So we want to see how many days do Shoprite Holdings, take to process its inventory. So there's a simple formula that we can use here, right? We can simply say 365 days divided by, and then we get the days. Okay, we can say, oh, okay, this is it, 62. Here they took about 53, and you can see that here there's an improvement from 2021. Here they were once taking about 2 months, right? And here they are now reducing, and we are seeing that as well because they've increased their inventory turnover ratio there. So there's a link there. And there's also another way of computing that. Mind you, here we just say 365 divided by this. So I just want to quickly show you another way as well. So another way would be to say, okay, we are saying average, right? So we're gonna take average. So we go to the balance sheet, right? When we go to the balance sheet, we take the average of the inventory here. So we say divided by. We divide it by the 2019 cost of sales. Then we multiply by 365 days. Okay, so it still gives us the same answer. So you can see here we still get the same answer here. Okay, so let's just proceed. Let's just use a simple formula here. So this divided by this. Okay, so we can see that they are now taking 9 days in 2023 to collect money from their customers. So let's just say 365 divided here. So we can still see that they're taking about 52 here days to pay their, this is close to 2 months. So they're taking 2 months to pay their suppliers, which is a good thing, because here they are, they're increasing. They've reduced the number of days they are collecting revenue or money that is being owed to the company by their customers, which is a good thing. Now let's compute the asset turnover ratio. So here we are just trying to see how efficiently management is using the assets of the company to generate revenue. Okay, because we believe that if we go to the balance sheet, the major asset there that we have is property, plant, and equipment. So sometimes we may compute the asset turnover. We may say, because the formula is total revenue divided by total assets, or total average assets. So yes, so we may say net revenue divided by fixed assets only, right? In this case, we may say only fixed assets, right of use assets, property, plant, and equipment. So basically we get that, but now we just want to use the total asset figure there. So let's just do that. So here we're gonna take revenue for 2019, right? 2019 revenue divided by average total assets. Okay, so here, let's come here. We have got average total assets. Perfect. And then we copy that to the right. So on average, over the year, we have got it's measured in times, right? Let me just quickly cross check here. Yeah, so 2.62 times, which is great. I think we can leave it like that, 2 times, something like that, which is okay. So here the comment is, for example, total asset turnover ratio range from less than 1 for large capital intensive industries, right? So we are saying, so here we are saying it is poor management to have an exceedingly high asset turnover relative to the industry, because this might imply too few assets for the potential business, or it could be due to the use of outdated, fully depreciated assets. It is equally poor management to have an extremely low asset turnover, because this implies that the firm is tying up capital in excess assets relative to the needs of the firm and compared with its peers. Okay, so I think for us to make a good judgment, we need to compare these ratios with Shoprite Holdings peers. Okay, so that we can make a good we can make informed decision. Okay, and be able to comment whether Shoprite is using dilapidated assets, or is it generating above average revenue from its assets or something? Is it efficiently turning those assets into revenue, okay, into generating revenue, right? So here let's do debt to equity ratio. So I'm just going to use a definition, in fact the formula that I got from Investopedia. So they were saying debt to equity ratio, we can take the total liabilities we divided by the book value of equity, right? So that's what we are going to now. So here we can say equals, then we go back to the balance sheet, we take the total liabilities figure, we divide it by the book value of equity. So this is it, okay. And so I think perfect. So I think here I can just copy that to the right, and then I can compute the long-term debt to capital ratio. So here I can come here and choose long-term debt, which is long-term debt here divided by the book value of equity, okay. So this one, and then I can copy that. So you can see this is it, guys, and I hope you've learned 1, 2, 3 things. And don't forget to subscribe if you've liked this video, and also share with your peers. Thank you for watching.